Want to know how to gauge the success of a potential real estate investment? The answer is simpler than you think. And in this video, I'm going to uncover the cornerstone of investing, how to calculate the return on a real estate investment. All right, first of all, let's talk about defining return on investment. Return on investment is going to be significant because, again, you're evaluating how much money did I invest in the project, and then what return am I getting on that? We're going to talk about how to calculate that and look at the formula because, again, you don't want to be just looking at things in a more, I'd say, blind way. You want to be looking at it in a very specific way as to what is my expected return. So let's dive in and take a look at these. So let's talk about the return on investment formula, okay? You've got your gain on the investment in whole minus the cost of the investment divided by the cost of the investment. So let's just break this down as a simple example. Let's say, for example, I put in $100,000 and when my investment is sold, I get back $150,000. Praise the Lord, right? So then now we take that $150,000 minus our original investment, which was how much? $100,000. That gives us the gain of $50,000 divided by our original $100,000. It is a 50% return on investment. That is phenomenal. You say, I don't know, Randy, is that possible? Yes, it is possible. I've seen it within our own investment opportunities that we've done. So not everyone, don't get crazy. Don't get crazy. You know, sometimes you see people out there going, oh my God, I'm making, 60% on, in like that's every single time, every single way. It's just simply not true. They're selling you something more than the truth. So, but again, it is possible, but more importantly, you want to focus on understanding how to really calculate your return on investment. Now, the other thing we want to talk about is really factoring in all the costs, right? Because again, there are certain times costs associated with it. Now, for us, we look at that in a holistic basis because there's cost associated with the purchase of the property, the acquisition costs, the financing costs, the taxes, the ongoing expenses and costs that we operate with the property on, and then ultimately what we net at the sale as a gross net from the overall transaction. So again, within that, even when we're selling a property, there's brokerage commission, there's closing costs, there's attorney's fees. All these things have to be netted out to get to a true return on investment, because you want to be calculating that, and we do too, from a realistic perspective. So you can't just fudge over and miss those numbers. You got to bring them all into the mix. If you're enjoying this video, make sure, give it a like and subscribe to my channel. Well, so now one of the things too, and I've seen what I'd call, less experienced, that's maybe a polite way to say it, investors, where they miss some of the, and this is before the investment, right? Okay, I'm considering this investment. What kind of return am I going to get? And they don't factor in all the operation costs, or they don't factor in the reality of what vacancy really would be given the moment in time. Or, in recent years with the pandemic, what would the bad debt collection be on a property based on those items? And so this is something that's really critical, that when you're evaluating things on the front end, what are those investments? Now, if you're investing passively, it's pretty straightforward, right? You invest $100,000 and you get that $50,000 gain. That's a 50% return, right? And we just stick with those easy math numbers. Now, if you're looking at it from a more perspective of buying the property directly, such as our company does, you really got to make sure that you're factoring all the costs properly, both on the acquisition costs, the rents that you would achieve, the expenses that are the real expenses, the bad debt that's a real ratio, the eviction that you have to deal with there, as what percentage that would be factoring into your bad debt. So these are all critical numbers that I've seen many kind of half cycle investors, right? They've been in a business 4 years, 5 years, where everything's just been like that. They miss some of these things, and then they overestimate what's going to be their results. And then now for them, in the last maybe 5 to 3 years-ish, the market's carried them along. That's not the case anymore. You've got to be a real operator, a real expert, to make sure that you're not only projecting the right returns on investment based on costs, but able to experience it based on execution. So let's talk about appreciation. I just mentioned, again, some of these half cycle investors have had the benefit of appreciation in the market, right? We've seen properties go up in value dramatically because there's been a significant push in rents because the demand's just been huge. And that's benefited everybody that's been an owner for sure. But so again, appreciation is not something that you just want to guess at. For us, we look at it as forced appreciation, meaning when we're buying a property, we're underwriting it and we're working on it in such a way where we know we can renovate the property for $8,000 a unit and bring the rents from $900 to $1,200 or $1,250. We know that we can cut expenses, and these items that we would do bring about a greater appreciation because the property's worth more because it has a higher NOI, net operating income. So again, that is a critical part of it, and it's a part of your overall return because see, now we've generated cash flow during the 1, 2, 3, 4 years that we own the property. So there's a return that's coming there in terms of actual cash flow. And then at the end, we sell the property for way more than we bought it, God willing, right? And then those two factors, the cash that we receive during the holding period and the appreciation that we capture on the back end, goes into our total return on investment. Time horizon in ROI is super important. There's another way that we term it, and we call it here in our office, it's velocity of money. Because the faster you're able to turn over the project and get those returns done, the more return on investment you're making. So for example, when you're investing in, say, the time horizon is targeted over 3 years and that the projected return would be, let's say, 18% or 16%, but yet now we're able to accomplish the project and the goals and the numbers in 2 years and sell the project, that boosts the return because you're shortening off another 12 months, and that's capturing a greater return on investment in the 24 months. So by bringing the timeline back, that helps to boost that ROI. So again, if we were tracking for a 16% return in 3 years, but now we're able to accomplish the project and hit the numbers of our sale exit in 2 years, that's going to boost the return on investment from 16 to 18, maybe even possibly 19, depending on what that appreciation and sale on the back end. And so again, velocity is important. That's what I said. People have asked me, hey, why would you sell it now? And it's like, look, I'm pragmatic. I'm doing it by the numbers, right? If we're able to execute and get the return on investment now and what we were targeting in 3 years and do it in 2, I'm always a taker on that in most instances because it's better for everybody involved. That's all I have for today. But before you go, I have a free gift for you in the description of this video. I'm here to keep you informed so that you can make the best decision when it comes to investing your hard-earned money. So I'm giving you my free guide to investing in multifamily real estate, which gives you all the insights I've gathered over the past 20 years of investing. Click the link in the description to download it today. I hope you were able to learn something today, and I'll see you in the next video.